What's going on, y'all? Cullen Gandy here, coming at you with another video about mortgage finance, personal finance, and just anything that has to do with getting you down the road to where you want to be financially. Today I want to talk about a subject that you're going to have a lot of interaction with if you become a mortgage loan originator or if you're going to become a real estate investor as well, and that is, what is a loan estimate and how does it work? Now, whether you're studying for the test or if you're a current working MLO and you just want to be able to explain the loan estimate to your borrowers a little bit better or understand the loan estimate a little bit better for yourself, this is the video that you're going to want to watch because there are a lot of moving parts when it comes to your loan estimate. Now, for the lender, the loan estimate is a really important document. It interacts with all of the big laws in the real estate and mortgage realm, which is to say TILA and RESPA, the two big heavy hitters. And that loan estimate is going to lay out what your obligations more or less are pretty much going to look like for the whole rest of the loan. That being said, I like to tell my borrowers that the loan estimate is just that. It's an estimate, but it's not a loan exactly right. There is going to be a certain amount of fluctuation on some of the items, especially when it comes to if a borrower is buying down on points and then decides to change something, if there's a change in circumstance, or if there's a change in perhaps the loan term that they want to do during the course of the loan, or if the escrows are incorrect on the loan and we have to verify different escrows, if they've changed over their homeowner's insurance or something, those numbers could always change, and that's going to change the bottom line of what the borrower or the lender is going to be responsible for at closing. It's your responsibility as a mortgage loan originator that loan estimate document needs to come out at least 3 business days or less after the first application is filled out by the borrower. That is the law. That is what the lender has to do. And there's a pretty steep fine if the mortgage loan originator doesn't manage to do that in a timely fashion. That is what's called a TRID violation, or a TILA-RESPA integrated disclosure violation, because when the borrower applies for a mortgage with a lender, that triggers TRID. And by TRID, you have to send out a loan estimate. You have to send out your terms to the borrower within 3 days. What's going to be primarily the things that you're going to be worried about when you're sending a loan estimate document to a person who's interested in a loan? Well, it's going to be on that first page, and that's always what I try to get my borrower to sort of focus on initially. What is the rate that has been agreed to? What is the term? And finally, what is the loan balance that you want, right? These are the most important things in any loan. What rate am I getting? How much of a deal am I getting? How much money am I going to be taking out? And how long am I going to have to be paying that money back for? That's the most important information. That's the information that you, as a borrower, don't want to, change. That's the stuff that you want to keep locked in. But it's also going to show you whether or not the rate is locked or floating, which is important to note if you're a discerning borrower, because a lot of sneaky MLOs and lenders like to say that, hey, we're going to offer you this rate, not quite locked in yet, so we'll let it float around, and it's just a little box there in the corner if you can see that. So if you see the rate on there and it looks really good, but if you look in the corner and it doesn't say locked in, you might not be as safe as you thought you were. Scrolling down on that first page, you're also going to see, what the principal and interest payment's going to look like, as well as what the estimated total payment's going to look like. That is to say, the principal, the interest, the taxes, and the insurance, or what I like to call the pity payment. After you get all of that stuff established with your borrower or with your lender, you're going to want to scroll down to the next and one of the most important parts of the loan estimate document. Now, the second page of the loan estimate document is where you're going to see all of the costs and the fees of the loans. On the left side, you're going to have all of the loan costs, and that's going to be, A through D. The A section is going to be your origination cost or your lender fees, and that's where all of the lender-related fees are going to go. So, for example, if you have any compensation for the mortgage loan originator, or what's called an origination fee, that's going to go in there. If the lender is offering any point buy downs to the borrower, that's going to go right in there as well. It's important to note that the costs and the fees that are listed in Section A are going to make up a majority of what adds to what's called the APR, or the annual percentage rate. Section B is going to be the services the borrower cannot shop for. These are the services that you have to essentially strong arm the borrower into using because there's no other option, right? They're the only ones that the borrower can use. A lot of times those are going to be the really fixed cost parts of the loan, like the appraisal. The borrower can't really choose an appraiser because that's a conflict of interest for both the lender and the borrower. Everybody wants it to come in a little bit higher than what you thought it was. As well, if there is a credit report fee, that's going to be in the credit report fee, or any sort of fees that are going to be incurred at the beginning of the process or around the application of the process. Section C on the left side of the second page of the LE is going to be the services the borrower can shop for, and this is going to be important because also there's going to be a whole nother calculation you need to do when you're talking about fees. Services the borrower can shop for are all of the other types of costs that are associated with originating the loan, right? This is going to be your lender's title insurance or the title in general. If there's a closing team, that's going to be in there. So all of those different costs are going to be in the Section C of the loan costs. And then Section D is basically just the total loan cost. So it's going to add up all of the different loan costs that are listed on the left side of the loan estimate. That is to say, all of the origination fees in Section A, all of the fixed costs in Section B, and all of the borrower services that they can shop for in Section C to give them an estimate of what their obligations are when it comes to the loan costs. However, the fees and the third-party fees are not the only costs associated with the loan. What are the other costs? Well, that's going to be on the right side of the second page of the loan estimate. And this is the side of the cost chart that I like to tell borrower, these things are going to be what they are, right? I can't really control what they are. They have to kind of be what they are, and I'm not going to be responsible for them being what they are one way or the other. These are going to be things like recording and title fees for the government or taxation for the government, as well as any escrow withholdings that we have to do if they're escrowing. So we're going to have to list what we estimate to be their taxes and insurance. Obviously, if we have to verify that and it's different, those numbers are going to change, but we're not going to be really responsible for listing that because, again, those are going to be what they are. So those things are counted as costs, but taxes, insurance, recording things, those are not fees. Those are just things that you have to get through in order to get that loan lawfully. And then you finally get to H. Those are any of the other costs associated with the loan that were unforeseen. Sometimes there's a condo questionnaire or something. Every now and again I'll see that in there, or if there's some sort of, if it's a homestead state, or if it's an attorney state, you have to have the attorney fee listed on it's either going to be in the borrower services they can't shop for or the other category. That's going to be plugged in there. And you're going to get the total cost to close from both of those two categories, the left column and the right column there. Those total costs are going to be the cost that the borrower is eventually responsible for. Going down to J and I there, you're going to see total other costs as well as total cost to close. That's going to have that whole round number in there. But then if you go beneath that, you're going to see all of the cash to close. And this is going to put together all of the most important information to give the borrower a really clear picture of what they might end up having to pay at closing, right? We're going to have what the loan balance is. We're also going to have that Section J in there, which is the total cost to closing. And I said those things can sort of fluctuate. And then you're going to have the total payoffs, right? That's what we're paying off in order to, for example, if it's a refinance, that's what we're paying off in order to assume the new first position. Or if it's a purchase transaction, that's the purchase price of the home. At the bottom, you're going to see that there's the cash to close. So if there's any differential in between, let's say the loan balance is much, much more than the purchase price or the refinance payoff amount, then some of those other costs or total costs are going to be subsumed or taken up by the extra loan balance. And so the difference there is going to be what the borrower is responsible for at closing, and that is the cash to close. Now, the amount can be from the borrower, that is to say the borrower can be responsible to pay money at closing, or if it's a cash out refinance kind of situation, that can be a situation where the borrower is receiving money. And there's different sort of categories for how those are calculated. And then once we get to that third page, that final page of the loan estimate, that's when we're going to see all of the background information that is sort of teased out by what the cost of the loan and what the fees of the loan are, as well as what are the terms of the loan, right? So that is going to be information like, what is the total interest paid? If we have this loan balance and it's over this term, how much money over the total period of time are you actually going to be paying? Spoiler alert, it's a lot of money sometimes. It's a big amount of money, and that percentage can sort of hit you right in the face. How much you could be saving, right? I mean, if you see that you have a total interest paid that's much, much less than when you, like, for example, if you were refinancing, that can really give you that net tangible benefit effect of, man, I'm really giving a good savings here. You're going to see what the APR is. That is the number that is going to be the second interest rate that exists when you add in certain kind of fees, especially like the closing fee and the origination fees in Section A of the loan estimate costs. You're also going to have, the total amount of payments, right? That's important to know as a part of the estimate that we're giving out to the borrower. And then at the very bottom of the page, as is required by law, that's going to be all of the information pertaining to who the person in the lending institution is that is sending this loan estimate to the borrower. In this case, it'd be Cullen Gandy. It would have my NMLS unique identifier, which is 2024149. It would have, for example, some of the borrower's information or the title person's information. If it ends up going to the closing disclosure, that's gonna be listed in there. And that's really important to establish so that they can know, if it's a reputable originator or a loan officer that's sending out these loan documents, and to see if these are being sent out lawfully according to TILA and RESPA. So now that we've gone over the entire loan estimate document, I wanted to get into a little more detail about what your obligations are as a mortgage loan originator when it comes to explaining the fees of the loan. You see, the fees of the loan are a very interesting and intricate part of the loan process because there's something that you're probably going to have to monitor if they change over the course of the loan. This is where loan fee tolerances come into play. And this is something you're also going to need to know if you're going to be taking the NMLS SAFE test. I know that they're going to put this on there. Please pay attention to this. There are 3 types of tolerances that you need to know about when you're talking about fees and how they can change and how much they can change by. 1, zero tolerance. When I say zero tolerance, that means that if a fee is listed in a certain category, that no amount more than that fee that we've listed on that loan estimate can be covered by the borrower. So the lender has to be responsible for anything in excess of what they are listing on the loan estimate. One thing that has a zero tolerance rate is the origination fees or points and things listed in that category A, right? We can't give you an estimate of an origination fee and then take it back and say, oh no, actually it's more at the closing disclosure, because any more than that, and it has to be covered by the lender. It has a zero tolerance. So zero tolerance, when you see zero tolerance, you're gonna think these are things that the borrower doesn't get to choose, right? These are the origination fees, and these are going to be like things like credit report fee, or sometimes the appraisal fee. Now I'll circle back on that because that can have a little wiggle room sometimes. Now, if you do have a change in fee and it has a zero tolerance, then let's say it costs a little bit more, right? You're going to have to cover the difference, and that difference is called a cure. And how they cure the loan process is that they either have to do an adjustment or they have to do a lender credit at the end in order to make sure that the borrower is whole as it was in respect to the initial loan estimate. Now, the second type of tolerance is going to be the 10% tolerance. Now, what does that mean? Well, if these kinds of fees change and they end up being 10% or less more than what we've quoted on the loan estimate, then they are going to be responsible to cover the difference. And by they, I mean the borrower. Let's say there is a fee that has a tolerance of 10%. And it was at $400, and now it has $440 on the closing disclosure. That will have to be covered by the borrower because that is within 10% or less more than the initial loan estimate. These are going to be for fees that you're going to find in that section C, where if they want to shop for their own title company, if they want to shop for their own settlement agent, and they have a list of 3 or 4 or 5 of them that we've provided, yeah, we'll give you the estimate, and if it ends up being a little bit more, you're going to have to cover it. But if it's more than that 10%, anything more than 10%, the lender has to cover the difference and get a cure. Then there are going to be those things that have no tolerance whatsoever. And these are the fees that the borrower goes out and finds and solicits as a part of the loan process that we didn't have any hand in offering them. So if the borrower has their own lender's title insurance or title company or settlement agent that they wanted to bring on board totally off of the list that we've given to them, then if they provide us with the fees to list on the LE and they're any different from what those people have provided to us, well, then the borrower is just going to be out of luck. They're going to have to cover the difference there because it has no tolerance. There is no amount of money more that the lender is going to have to cure those costs for. But the absolute most important thing when you're talking to borrowers about the costs of the loan is on that right side. Because this is one of the things that can kind of spook the borrower initially and make them not want to sign the loan estimate disclosures and all the different disclosures that they have to sign in order to get into the loan process, because it can add a lot to the costs, and they think that they've got more fees, but they really just have more costs, but they're costs that they're already going to have to pay anyway. Taxes and insurance are not fees, and they are going to have to pay them. So regardless of whether or not we have to collect for them, it's really a moot point because we're either going to pay them at closing or they're going to have to pay them later on their own. Either way, taxes and insurance, recording fees, these are things that they have to pay anyway. They are adding to the costs, but those are the costs of doing business, and those are the costs of owning property. If you can adequately explain to your client that side of the loan estimate cost disclosures, then you are going to have a client that is not going to hesitate at all about pulling the trigger, getting into underwriting and processing, and getting that rate that you've sold them. What's going on, everybody? As I was editing this video, I realized I didn't explain one of the more difficult parts of the loan estimate that you have to explain to people during the course of the sale, and that is the prepaids section. Basically, if you know about prepaids, those are always paid in arrears. That means that you're always looking back, paying those and collecting for those if they haven't been recorded as being paid. Now, the 3 big things you're going to look out for: the homeowner's insurance or homeowner's insurance premium, and the prepaid interest, any property taxes. So, for example, property taxes, a lot of times one thing that a lot of borrowers can get sort of hung up on is, hey, look, I paid my taxes, I got in touch with my escrow and they said they paid them. Well, there's a lot of situations in which the escrow agent will have purported or told the borrower that they paid them, but they haven't been recorded yet at the tax assessor's office. So in this case, we have to collect for those. And if there's a duplicate payment that ends up going to the tax assessor, obviously that gets refunded back to them. The same thing goes for the homeowner's insurance premium. We have to make sure that the current payment status of the homeowner's insurance has to be met so that we can make sure that there are no undue encumbrances or liens or anything going on, or to make sure that we're in compliance with what we need to be doing as far as the sale going forward or the refinance. And then finally, the mortgage insurance premiums and prepaid interest. So those are for purchases. If you have to pay an upfront mortgage insurance premium or something like that, that's going to go there. As well, the prepaid interest, that is something where, ostensibly during the course of your loan, it closes on a certain day of the month, and interest has been accruing up until that period. And so we have to pay prepaid interest to the lender to account for each of the days that has gone by in the month to make sure that, at closing, we've got all of our ducks in a row and we've collected for everything that we need to collect for. Thanks so much, everybody. I hope you enjoyed and found a lot of this information helpful, especially, if you're starting out. This is something that you really want to have a good handle on because this can also be a sales technique, just guiding them through the loan estimate. If they feel like the transition is smooth, they're more likely to stay with you in the long run because you're going to seem like you know what you're talking about, right? I mean, you got them fooled. You got to fool yourself a little bit, fake it till you make it. But the main thing is to seem like you know what you're talking about. And, that's a really good asset to have when you're a salesperson. At any rate, guys, if you enjoy informative and educational content like this, please go ahead and leave me a like, a subscribe, and smash the notification bell. Is that what they call it? I really want to notify you. So just hit that bell so that you can get notified about more content like this. And I will see you in the next one, hopefully a little bit richer and a little bit happier. Peace.